the end of an era. I mean, truly. The most anticipated corporate transition in modern financial history is now formally underway, and we are diving deep into the definitive moment. Warren Buffett's final annual meeting as CEO of Berkshire Hathaway.
This deep dive is monumental. And it's not just for, the emotional weight of one of the world's greatest investors stepping down, but it's the sheer scale of the organization he built.
Oh, absolutely.
We're talking about a company that grew from a struggling textile mill that Buffett took control of back in 1965. I mean, a business that was essentially worthless into an entity valued at over $1 trillion as recently as August 2024.
That growth trajectory it's almost unbelievable. For context for you listening, we're looking at a 19.8% compound annual growth rate from 1965 to 2023.
Yeah.
To sustain that kind of performance across, 5 decades, managing massive, massive amounts of capital and just far, far outpacing the S&P 500, it's something we will likely never see again.
And that's exactly why this moment of transition is so critical. For those of you who submitted the sources for this deep dive, and we got a lot, the post-meeting analysis from Omaha, the detailed Q3 2025 financial reports, and the refresher on Buffett's core investment philosophy, you gave us an incredible body of work to distill.
Our mission today is to cut through all the sentimentality, all the noise from the financial press, and really capture the essential, actionable insights. So first, what is the precise operational and financial state of this behemoth right now?
Right.
And second, how exactly is the defined succession structured? What is the new leadership's immediate strategy?
And finally, what are the enduring, the non-negotiable principles, the core cultural DNA that will guide this massive company into a much more volatile, technologically driven economic future? It's really about understanding how the success of the past can be maintained without the genius who engineered it.
We had some major news to start with. Confirmed at that May 2025 annual meeting, Warren Buffett officially announced he would step down as CEO at the end of 2025.
After 6 full decades at the helm.
6 decades. And this announcement, we all sort of anticipated it, but it still sent ripples through the financial world, especially because it came just as Berkshire reported some seriously robust numbers.
Oh, financial position is spectacularly strong. They reported Q1 2025 operating earnings of $11.2 billion, which, that really reflects the health and efficiency of the underlying businesses, from Geico to BNSF. But the number that truly defines this moment, and frankly defines the challenge for the incoming CEO, is the cash hoard.
The famous cash mountain.
Exactly. It stood at $182 billion as of the end of Q1 2025. And based on the rate of profit retention, Buffett himself was forecasting it would approach $200 billion by the end of Q2 2025.
And all that money is just sitting there, waiting for deployment. It represents either the ultimate strategic patience or, as some critics might suggest, the ultimate restraint imposed by the company's sheer size.
It's a huge question.
Okay, so let's unpack this. What does the state of the company look like at this moment of transition? And what does the handoff actually entail for the leadership team? A team tasked with handling this mountain of capital, which, as we'll see, is actually even bigger than that initial $182 billion figure.
The transition plan, which was confirmed with unprecedented clarity in May 2025, it has 2 major layers. The first layer is all about operational and cultural continuity.
Okay.
Buffett made it really clear that while he's stepping down, he will still hang around. He added that he could, and this is a quote, conceivably be useful in a few cases.
Right, which sounds like a consultative role, not an operational one. But the critical point is where the actual power resides now. I mean, where is the buck going to stop?
The buck stops with Greg Abel. Buffett announced that the final word on operations and, crucially, overall capital deployment will officially go to Abel at the close of 2025.
And that gives Abel the complete authority to decide where Berkshire's billions are invested, whether it's acquisitions, public stocks, share repurchases, everything.
Everything. That final word is the key because for 6 decades, that word belonged solely to Buffett and until his passing was very heavily influenced by Charlie Munger.
What's fascinating here and what the source material really highlights is the extreme confidence Buffett placed in Abel. It wasn't just, a managerial sign-off. It was a profound financial endorsement.
It was maybe the most compelling statement of the entire meeting. Buffett stated that he has no intention, zero, of selling 1 share of Berkshire Hathaway.
Wow.
He views the decision to keep every single share he owns as a pure economic decision, openly stating that he thinks the company's prospects will be better under Greg Abel's management than his own.
Wait a minute. If he genuinely believes Abel will be better, why did he wait until 2025 after Munger's passing to finally step down? Could that statement, about Abel being better be a subtle admission of his own recent stagnation? Or maybe the inability to find those huge high-return deals in the last few years?
That is the subtext that analysts immediately picked up on. I mean, Buffett himself has lamented the difficulty of deploying enormous capital at high rates of return.
Sure.
By stating Abel will be better, he's acknowledging that Abel, who is younger and arguably more technologically fluent, might just be better equipped to adapt Berkshire's deep value strategy to a modern, faster-moving economy. The delay, though, was likely a mix of personal commitment and the desire to ensure the culture was absolutely locked in before he left the cockpit.
So let's nail down these new leadership roles and the division of labor. We've got a clear hierarchy now. Greg Abel handles CEO and the colossal overall capital allocation role. What about the other equally critical pillar, the vast insurance operations?
That domain remains under the control of Ajit Jain, who continues to serve masterfully. Buffett voiced unwavering confidence in both men, noting specifically that Abel understands businesses extremely well from an operational perspective, having overseen Berkshire's non-insurance subsidiaries for years.
So Abel handles the primary interface with all those operating executives across the dozens of sprawling subsidiaries.
He does, and it seems like Abel and Jain are the perfect duo. One, a master of operations and capital, the other, a master of risk management and the insurance float.
The ultimate 1-2 punch for a conglomerate like this.
Exactly. Abel also reflected on the intellectual environment that prepared him. He specifically mentioned that the late Charlie Munger was a remarkable teacher, really emphasizing Munger's influence in shifting the focus from, those cigar butt stocks to wonderful businesses.
And Buffett himself shared a crucial, fundamental insight into his own learning process, which links back to his early days of reading Ben Graham.
He did. He noted that he spent significantly more time looking at the balance sheets of potential acquisitions than he did looking at the income statements.
Which is the ultimate margin of safety mentality.
It really is. It's focusing first on asset quality, liability exposure, and whether the capital is protected before you start worrying about quarterly earnings or growth rates. It speaks directly to the deeply conservative nature of Berkshire's capital deployment philosophy.
And that emphasis on the balance sheet, it leads us directly to the heart of the non-financial discussion at the meeting. The culture as a moat. The idea that the company's endurance is tied to its shared ethos.
The vital role of Berkshire's culture, defined by trust, extreme rationality, and an unrelenting long-term focus, was maybe the most prominent message shared by Buffett, Abel, and Jain. They believe this culture is the company's most essential moat for endurance.
Even more important than the operating assets themselves.
That's what they're saying, and when you trace back Berkshire's origins, that endurance is truly remarkable. It originated in the New Bedford textile industry in 1955, and Buffett closed the last of those original mills in 1985, a 30-year span to fully excise a bad business decision.
That kind of patience just defines the culture.
It does. It demonstrates the willingness to wait for the highest return, even if it means slowly winding down a piece of history. Analysts today, they look at the current structure, which spans railroads, massive energy utilities, candy, and insurance, and they often compare it favorably to the S&P 500 index, but they add that powerful caveat without the bad bits.
Right, because unlike the S&P 500, Berkshire actively uses its capital to fix or jettison the struggling businesses, maintaining only the ones with durable economic advantages.
Precisely.
So if we connect this to the bigger picture, this handoff isn't just a corporate reorganization, it's the ultimate test of whether a culture instilled by a single genius over 6 decades can genuinely self-perpetuate under new management.
And that question leads us directly to the most fascinating strategic challenge. The capital allocation strategy. I mean, can Abel maintain the discipline and achieve the necessary returns when he's sitting atop an unprecedented mountain of cash?
Here's where it gets really interesting. How does this leadership shift affect the company's massive capital decisions, especially given the market's reliance on Buffett's personal touch for making those urgent multi-billion-dollar deals during periods of panic? Abel now controls the largest corporate cash hoard in U.S. history.
The word hoard almost doesn't do it justice. We have fresh, consolidated data confirming just how gigantic this cash position is. So while the Q1 report showed $182 billion, The fuller consolidated figures show that as of June 30, 2025, the company had $344 billion parked in U.S. Treasury bills alone.
Okay, $344 billion.
Plus an additional $44 billion in reported cash reserves across its subsidiaries.
Right, let me repeat that for you listening. $388 billion. That is liquid capital, largely held in short-term government debt. That is more than the GDP of many mid-sized countries. How does Abel sleep knowing he controls the world's largest corporate war chest?
Well, it's not just a war chest. It's an investment strategy born of necessity and discipline. Buffett admitted at the meeting that they hold a lot more in cash and treasuries than I would like. He stressed that holding this much cash is the necessary cost of maintaining optionality.
Optionality for what?
The fat pitch. Yeah. He stressed that they need to remain ready to act decisively when real opportunities occur every 5 or 6 years. This is the core of their contrarian philosophy. They have to have the money ready when the market is paralyzed by fear, and deals that are otherwise unavailable become possible.
And we saw this strategy deployed spectacularly during the 2008 financial crisis. Can you remind us of some of those historical examples to give some context for what that $388 billion is waiting for?
Absolutely. In 2008, when the credit market seized up, Buffett was able to provide crucial, high-interest capital to distressed firms. You think of the $5 billion preferred stock deal with Goldman Sachs, which included warrants that eventually generated massive returns.
Right, in GE.
And the deals with GE and Harley-Davidson, those were deals where Berkshire used its pristine balance sheet and reputation to negotiate terms that were impossible for anyone else, essentially taking equity-like returns for debt-like risk.
So this massive cash hoard isn't passive. It's deliberate, strategic patience. It's designed to be deployed only during moments of widespread market panic, securing returns that are only available to the ultra-solvent.
Precisely. Buffett even provided a highly contrarian perspective on volatility. He said, and I'm quoting, "If Berkshire went down 50% next week, I would regard that as a fantastic opportunity." His message is clear. Fear in the market is directly proportional to opportunities for Berkshire.
So that $388 billion acts as a sovereign wealth-sized entity ready to absorb and capitalize on the next major economic disruption.
Yes, and the opportunity cost of holding low-yielding treasuries right now is simply the price of admission to ensure they can secure those fat-pitched deals in the future.
Okay, but the cash hoard is only one part of their capital structure. We absolutely have to discuss the foundational pillar that generates that capital and makes their entire investment model so unique: the insurance float.
The insurance business is truly Berkshire's core pillar, and the float is often called the secret ingredient. The model is rare. They are paid cash up front, the premiums, or the float, before they have to pay out claims, which are the costs. They are, in essence, investing capital that temporarily belongs to someone else, but they can hold and invest it for decades.
And the cost of that capital is where the magic truly lies. It's just incredibly low, if not negative.
Agent Joan confirmed this spectacular metric for the audience. Over the long term, their cost of float is negative 2.2%.
Negative 2.2%.
Let's just take a moment to unpack the magnitude of that statement. They are literally being paid 2.2% of the cash they hold to invest it.
That is almost impossible for a standard financial institution to achieve.
Buffett made a fantastic analogy to explain this. He compared it to running a bank where people deposit money with you, but instead of you paying them interest, they pay you a negative interest rate to keep the money there.
So it creates permanent, low-cost capital that can be used to fund acquisitions or hold public equities like Coca-Cola and American Express without the pressure of quarterly redemptions or client withdrawals. It's like an OPEC of capital.
It is. It's a tremendous economic moat. But the sources also highlight that it's not without immense long-term risks.
Right.
Absolutely not. While this strategy fuels long-term investment, it comes with immense delayed liability risks, what they call long-tail liabilities. The costs of claims can and often do exceed the premiums, sometimes decades later. The sources confirm that Berkshire continues to make substantial payments due to asbestos liabilities that were assumed over 50 years ago.
50 years ago. That time lag is just staggering and really underscores the patience and risk appetite required.
It highlights the need for that massive balance sheet protection. The source material also explicitly warns that future liabilities from emerging environmental and health issues, materials like talc and PFAS chemicals, could pose similar multi-decade challenges, requiring extreme prudence in reserving capital today for claims that might materialize in, say, 2075.
And then there's the modern systemic risk that keeps the insurance industry's top minds up at night, which is cyber risk.
This was a key discussion point. Buffett stated very candidly that the aggregation risk in cyber insurance is immense and could potentially break the company if they were not managed with the utmost prudence and constraint.
And by aggregation risk, he means a catastrophic cyber event where all their insured companies are hit simultaneously.
That's it. It's the definition of the black swan risk they must perpetually prepare for. So Ajit Jain's continued oversight of this precise risk is therefore absolutely non-negotiable for the stability of the entire enterprise.
Okay, before we move to the portfolio, let's quickly address capital allocation through share repurchases. It's a favorite tool of many value investors, including Buffett, but that practice has notably slowed down in 2025.
Yeah, they have not made any substantial share repurchases so far in 2025. This is partly due to the prevailing 1% tax on repurchased shares implemented by the U.S. government.
But is a 1% tax really enough to deter a multi-billion-dollar operation?
For a disciplined buyer like Berkshire, yeah, if the stock isn't trading at a significant discount. Buffett used a high-profile example to illustrate the financial drag. He noted that Tim Cook at Apple spent about $100 billion repurchasing shares in a year. The 1% charge on that now costs Apple $1 billion annually, which is essentially an extra unavoidable cost of capital. Berkshire's rule is strict. They will only buy back shares if they believe the stock is almost certainly underpriced, and that 1% tax simply raises the hurdle for that decision.
It's also crucial to highlight Berkshire's enormous self-proclaimed contribution to the U.S. government, which underscores the huge profitability of their underlying operating businesses.
The scale is indeed unbelievable. Berkshire paid over $5 billion in federal taxes for fiscal year 2024. But Buffett announced proudly that Berkshire paid a total of $26.8 billion in corporate income tax last year.
$26.8 billion.
To put that in perspective for you, that accounts for about 5% of the total amount paid by all U.S. companies.
5% of the nation's corporate tax bill from one company. Why do they highlight this so forcefully?
Well, they highlight this to demonstrate two things. First, the success of the American miracle, which is the backdrop for their entire investment thesis. And second, it highlights the shareholder commitment to continuous reinvestment rather than dividends. Every dollar retained and reinvested successfully generates massive taxable income later.
So it proves that their decision to forego paying dividends, a position they've held since 1967, is working, because the retained capital is generating staggering amounts of wealth and profit.
That's the argument.
Okay, let's move now to their famous investment portfolio, the collection of marketable securities that everyone tracks with such intensity. The major takeaway from Q1 2025 was the significant adjustment to the long-held Apple stake.
This was the headliner news for many. Berkshire sold approximately 115 million Apple shares in Q1 2025. And this immediately sparked speculation that Buffett or Abel was losing faith in the largest holding.
Which sounds like a major strategic shift away from a cornerstone holding that, at its peak, represented nearly half of their entire equity portfolio.
Yeah, and Buffett went to great lengths to clarify that this was not a loss of faith. He insisted the move was largely for tax management purposes, specifically citing the desire to realize gains now rather than later when conditions might be less favorable. He fully expects Apple to remain Berkshire's largest common stock position for the foreseeable future.
But didn't analysts suggest this move was also a tacit admission that Apple's massive weight in the portfolio, peaking around $174 billion in 2023, violated their long-standing rule about avoiding overconcentration?
That is the critical, non-spoken critique. While Buffett claimed tax reasons, the trimming brought the position back down to roughly 20% of their equity investments, which is a much healthier concentration level for a portfolio of Berkshire's size. It shows Abel applying a slight brake on concentration risk, even in the crown jewel holding.
And despite the trimming, Buffett continues to laud Apple with high praise. Why such reverence for a company in the volatile technology sector, given his historical avoidance of tech?
It connects back perfectly to the fundamental principles of durable competitive advantage. Buffett views Apple not as a technology stock, but as a consumer goods company with an incredibly strong, sticky brand, what analysts call the iPhone effect.
A consumer moat disguised as a tech stock.
Exactly. The loyalty of its customers, the recurring revenue from services, it all creates predictable, long-term earnings, much like Coca-Cola or American Express.
So the trimming was strategic, confirming that Berkshire is continuously shifting capital, even in its most successful positions. But let's look at recent non-stock capital deployments, which is where Greg Abel's strategic focus is most clearly seen.
We saw two major non-insurance capital deployments in 2025. First, the massive commitment to Occidental Petroleum. In October 2025, Berkshire acquired Occidental Petroleum's subsidiary, OxyChem, in a $9.7 billion cash deal.
Their largest deal in 3 years.
It was.
So why acquire a chemical subsidiary, OxyChem, as part of an energy-focused conglomerate?
It's pure strategic synergy. OxyChem is a key part of the oil and gas vertical, providing chemicals essential for enhanced oil recovery and other industrial processes. By acquiring it outright, Berkshire deepened its involvement and vertical integration with Occidental. As of September 30, 2025, Berkshire owns 26.9% of Occidental common stock.
Which is a substantial stake.
A substantial stake, cementing the investment thesis that Occidental is a long-term winner in the U.S. energy space. Abel is clearly betting on continued large-scale domestic energy production.
And second, the surprising international play in Japan, which is highly unusual for a company historically focused almost entirely on the American miracle.
This move into the 5 major Japanese trading houses, Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo, is the exception that proves the rule about their long-term patience. Berkshire has been increasing its investment in these firms and plans to hold them for decades.
What's the strategic appeal of these Japanese houses?
They are deeply diversified, highly cyclical, and most importantly, they were trading significantly below intrinsic value, classic, Munger-esque great businesses at a fair price. The market value of these stocks had reached $23.5 billion, representing a significant paper gain over their cost of $13.8 billion.
And they employed a fascinating, complex currency strategy for that investment that points to a more sophisticated approach to international investing.
Yes, this is where Abel and the Treasury team's sophistication really shines. To maintain a roughly currency-neutral position, meaning they don't bet on whether the yen will strengthen or weaken, they borrowed funds in yen. They explicitly stated that neither Abel nor Buffett has an opinion on future currency trends, so they offset the currency risk of holding the yen-denominated assets by having yen-denominated liabilities.
So they essentially leveraged cheap, long-term yen debt to hold these undervalued international companies. And what was the accounting consequence of that approach?
According to GAAP accounting rules, the strong U.S. dollar resulted in a required accounting gain of $0.85 billion in 2024 alone, just from the movement in the yen-denominated debt. This approach demonstrates a mild but important expansion of the traditional circle of competence.
How so?
They are now willing to look internationally and use financial engineering, like the yen debt strategy, in ways that previous capital deployment often avoided. It confirms Abel is willing to go further afield for value.
It's easy to focus on the triumphs, but Buffett is famous for his brutal honesty when discussing failures. The sources also highlight some noteworthy portfolio challenges, proving even the Oracle of Omaha is human.
The biggest, most recent pain point has been the disastrous investment in Kraft Heinz. The September 30, 2025 financial reports disclosed a massive impairment charge of $3.76 billion related to this common stock investment.
A $3.76 billion hit. That has to be incredibly frustrating. A multi-billion-dollar charge on a deal that was supposed to be a safe bet on consumer staples. Exactly the kind of predictable, moated business Berkshire loves.
It's a massive, painful lesson in the importance of price. Buffett previously admitted to the mistake, confessing that he overpaid for Kraft Food Group back in 2015 when it merged with Heinz. He bought a great business, but at a terrible price.
So the impairment charge is a formal recognition that the asset's recorded value is no longer recoverable through its expected cash flows. It's a permanent reduction of value.
It is. And it's important to slow down here and recognize that even at the highest level of investing, these judgment errors happen.
What other historical mistake did Buffett cite as a humbling experience?
He cited the past exit from the British retailer Tesco. Berkshire realized an after-tax loss of $444 million on that investment. And the reason for the loss wasn't just poor business performance, it was Buffett's own indecision.
Right.
He confessed that thumb-sucking caused a costly delay in selling after he soured on the company's management and ethics. It's a very human admission that inertia can be an expensive error.
And we also see the complete final divestment from another long-held financial name, Wells Fargo.
That holding dated all the way back to 1989. It was a classic, for-freedom stock, something Buffett loved for its predictable economics. However, following years of legal and ethical struggles at the bank, Berkshire Hathaway had fully sold its interest by the first quarter of 2022.
Which showcases that patience, even legendary patience, has its limits when that fundamental quality or competitive advantage, the core moat, erodes or is tarnished beyond repair.
It does. And that tension is the core of successful capital allocation. It reinforces the need for that margin of safety principle, buying cheap enough so that when mistakes inevitably occur, and they always do, the permanent loss of capital is limited.
Let's pivot now to the massive operating businesses that form the backbone of the conglomerate, starting with BNSF Railway. The 2009 acquisition of BNSF was historic for its scale and its philosophical significance.
It was a truly profound purchase. It was Buffett's largest acquisition at the time, $26 billion plus the assumption of $10 billion in debt. He famously described it as an all-in wager on the economic future of the United States.
Because rails move everything the country makes, consumes, or exports. It remains one of their two largest non-insurance businesses.
It does, and its performance has been steady, showing resilience, but growth is modest, sort of mirroring the broader U.S. economy. For the first 9 months of 2025, BNSF saw operating revenues increase slightly, and core unit volumes were up 2.1% compared to 2024. Pre-tax earnings were up a respectable 6.8%.
That modest growth suggests mixed signals beneath the surface. What were the specific operational challenges that BNSF faced within that 9-month period?
They faced several headwinds. Volumes were lower in industrial products, primarily due to reduced demand for construction materials. More significantly, they saw lower petroleum product shipments, which suggests a deceleration in that energy vertical. And they also dealt with lower fuel surcharge revenue due to stable or falling fuel prices.
But those headwinds must have been offset somewhere. Where was the strength?
The strength came primarily from agricultural products, driven by higher grain exports and continued volume growth in intermodal and consumer product shipments. So you're right, BNSF acts as a perfect microcosm of the U.S. economy. Manufacturing and energy sectors are cooling, while consumer spending and agriculture remain resilient.
Now let's move to the other massive operating unit, Berkshire Hathaway Energy, or BHE. This is one of the most geographically diverse utilities, serving customers across 28 states, Great Britain, and Canada.
And BHE is facing an existential crisis right now. While the BNSF wager was on the stability of the American economy, BHE's future is clouded by the immense regulatory and environmental crisis of wildfire liability, particularly in the western U.S.
Greg Abel addressed this directly, calling the fallout from the 2020 wildfire their largest challenge. What exactly does it mean when he says they became responsible for the fire effectively through the courts? This is a crucial, complicated legal concept.
This is where we need to explain the concept of inverse condemnation. It's the legal mechanism in some Western states that is fundamentally changing the utility investment thesis. Inverse condemnation means that even if the utility, in this case Pacificor, did not act negligently, if their equipment contributed to the fire, the state can assign liability for the resulting damage to the utility.
So the liability falls onto the company, regardless of direct operational fault, and the costs are staggering.
Exactly. Abel emphasized the critical message in Omaha: they cannot be the insurer of last resort. If climate change-driven risks like increased drought and high winds are consistently downloaded onto utilities via this legal doctrine, it fundamentally challenges the economic model where companies rely on regulated returns. The cost burden is just too massive for the existing regulatory structure to support.
What mitigation strategies are they implementing to deal with this multi-billion-dollar climate-driven risk?
The response is unprecedented in scale. Pacific Corp is aggressively expanding its wildfire mitigation programs. They are planning approximately $2 billion in investment between 2025 and 2027 alone.
$2 billion specifically for fire mitigation. What does that money buy?
That investment buys asset hardening in high-consequence areas. This includes rebuilding overhead lines with covered conductor, which is highly insulated cable that prevents arcing converting high-risk lines to underground where it's feasible, and installing hundreds of weather stations and advanced monitoring equipment to improve risk modeling and quicker fault detection.
Allowing them to proactively shut off power when conditions are extreme.
That's the idea. The costs of fighting climate-driven risk are becoming an absolutely unavoidable, massive operating expense that fundamentally changes the risk-reward calculation for utility investments.
On a more positive note, BHE is also a major player in the energy transition.
They are. They're heavily invested in renewables, demonstrating that even while fighting massive liability, they're preparing for the future. Berkshire Hathaway Energy had invested approximately $26 billion in owned wind energy resources through 2024.
And their subsidiaries, like Mid-American Energy and Pacificor, are consistently ranked as top U.S. investor-owned utilities for wind power capacity.
They are. And the change in their generation mix since 2005 is staggering. Back in 2005, coal dependence represented 71% of their power generation. By the end of Q3 2024, that was down to 22%.
And their goal is to get coal down to 20% by 2030.
That's the stated goal, while dramatically increasing wind to a projected 33% and solar to a projected 15%. And to achieve this, they are undertaking huge transmission projects like the $4.2 billion Greenlink Nevada initiative, specifically designed to deliver renewable energy across the western U.S.
That's a huge necessary capital outlay. And it brings us back to the insurance side for a moment. BRK.A, their famed auto insurer, had operational struggles during the pandemic and subsequent inflation, but has seen a significant turnaround in the last 18 months.
The turnaround at BRK.A was a main engine of Berkshire's profit growth in 2024. Ajit Jain confirmed that BRK.A continues its massive technology-focused push to enhance data analytics for better risk assessment. They are finally competing effectively on the pricing front through superior data gathering.
And Buffett noted that CEO Todd Combs, who was previously one of Berkshire's investment managers, has made major reforms to improve efficiency and underwriting practices.
Yeah, Buffett called BRK.A a long-held jewel that needed a major facelift. The key was moving from a simple low-cost model to a data-driven low-cost model. They are utilizing telematics tracking driving habits and enhanced algorithms to achieve top-tier competitiveness by the end of 2025 while maintaining that famous low-cost structure.
The jewel is shining again.
Thanks to a healthy dose of technology and efficiency.
Finally, let's turn to the philosophical cornerstones. It's impossible to talk about the future of Berkshire without a detailed understanding of the evolution of Buffett's investment style, because this philosophy is what Greg Abel inherits. And he didn't start out buying apples and Coca-Colas.
That's the crucial context. His early style was pure Benjamin Graham, often referred to as the cigar butt approach. This meant finding struggling, mediocre businesses that were so cheap they were trading below their liquidation value.
The ultimate bargain hunter.
Exactly. You buy the company for less than its component parts are worth, you liquidate the assets, and you get one last puff of value out of the deeply discounted assets, regardless of whether the underlying business was sustainable or well-managed. Dempster Mill was a classic example. It was purely numerical, asset-based bargains.
And the profound shift, the one that turned Buffett into the investor we know today, was largely influenced by his partner, Charlie Munger.
That is correct. The later successful evolution shifted dramatically. They moved from buying struggling businesses cheaply to prioritizing high-quality businesses with durable competitive advantages, the economic moats, even if they had to pay a fair rather than a bargain price.
As Munger famously stated, it is far better to buy a great business at a fair price than a mediocre one at a bargain price.
That's the one. And you can see those different moats in the current portfolio. We discussed Apple's brand moat, but BNSF has a structural moat based on the difficulty and cost of replicating railroad tracks. BRK.A has a cost moat based on its superior expense ratio. Coca-Cola has a brand and distribution moat. The shift in philosophy means they only buy companies where they're confident the underlying advantage will last for decades.
But the core tenets of Benjamin Graham, the original mentor, never really left the framework. Which ones remain foundational?
Two tenets remain the absolute foundation. First, the margin of safety. Only buy at a significant discount to intrinsic value to protect against errors in judgment or unforeseen market volatility. This is the protection that allowed them to survive the mistakes like Kraft Heinz and Tesco.
And the second tenet, which directly impacts their current view on technology, is the circle of competence.
Absolutely vital. The circle of competence means you only focus on companies whose operations and economics you comprehend deeply. Buffett has often said that the size of the circle is insignificant, but having a clear grasp of its limits is crucial. This explains his historical, disciplined aversion to industries undergoing rapid, unpredictable, change-like cutting-edge technology.
And speaking of rapid, unpredictable change, let's talk about technology and AI, which dominated many of the philosophical discussions at the final annual meeting.
Buffett remains profoundly confident in the larger American outlook, believing the nation will continue to prosper despite political and economic divisions, and that new technology won't eliminate opportunities for astute investors. However, his specific comments on AI were highly cautionary and deeply personal.
He had that compelling anecdote about seeing the technology used maliciously.
He did. He recounted seeing an AI deepfake of himself, which he described as astonishingly realistic. He stated that the technology has enormous potential for harm and expressed genuine nervousness about the pace and implications of the sector, particularly around misrepresentation and fraud. He views this as a truly unique and potentially catastrophic risk.
It seems like that nervousness is reflected in the current market's almost hysterical enthusiasm for AI, a type of speculative frenzy that Berkshire typically runs away from.
It absolutely is. One fascinating statistic shared recently compared the current market frenzy to historical booms. The investment excitement ratio for the AI story in the U.S. stock market today stands at 20 times.
20 times. What does that mean in historical context?
For comparison, the investment excitement ratio for the 1880s railroad boom, which Buffett and Munger pointed out led to decades of terrible investment returns, was only about 5 times. The current excitement level around AI is 4 times larger than the railroad craze. This reflects the intense capital competition and fundamental uncertainty in the tech space that keeps it squarely outside the circle of competence for Berkshire's core value approach.
Finally, we need to touch on something very personal to Buffett that underscores the culture he is leaving behind. His stinging criticism of modern CEO pay, which he highlighted strongly in his final address.
This was a stinging rebuke of modern corporate governance practices. Buffett criticized the culture of skyrocketing CEO pay, describing it as a mix of envy and greed. He noted that the original intention of regulatory requirements to publicly disclose CEO pay was to serve as a mechanism for restraint.
But it completely backfired. Instead of restraining pay, it fueled a competition among executives.
Correct. He argued it inadvertently fueled a competition among executives, driving them to match or surpass high compensation packages. He was highly critical of the ego-driven nature of executive suites demanding massive pay increases just because their peers received them, regardless of relative corporate performance.
And the irony couldn't be sharper when contrasted with his own personal compensation structure.
It creates a tremendous cultural juxtaposition. Buffett's official salary has been $100,000 per year for 35 years, one of the lowest for a major CEO in the U.S. He receives only about $300,000 annually for home security services on top of that.
And in stark contrast, his key successors, Greg Abel and Ajit Jain, each received $20 million base salaries.
Right, and this difference illustrates the fundamental challenge for Abel, maintaining the founder's austere long-term ethos while operating within the demands of modern corporate compensation.
So what does this all mean? We've looked at the financial powerhouse that is Berkshire Hathaway in 2025, the formal passing of the torch, the strategic portfolio adjustments, and the philosophical guardrails that have been firmly locked into place for the next generation of leadership.
The central themes are absolutely crystallized for you listening. First, the immense optionality providing capital reserves approaching $388 billion are ready to be deployed, confirming a strategy of patience in an impatient market. Second, the underlying operating businesses are showing resilience, an incredibly successful operational turnaround at Geico, but an immense multi-billion-dollar headache emerging from the utility wildfire liabilities at BHE, which changes the regulatory risk profile.
And third, the critical handover of capital allocation power to Greg Abel, demonstrated immediately by major strategic moves like the $9.7 billion OxyChem acquisition and the sophisticated yen-hedged Japanese holdings. This is balanced by the need to immediately admit and quantify past failures, such as the massive $3.76 billion impairment taken on Kraft Heinz.
The culture of durable competitive advantage remains the non-negotiable guiding star. But the company is positioned to capitalize on volatility under massive constraints. The self-imposed limit of only buying elephants or massive deals, and the cultural commitment to avoid industries they don't fundamentally understand, like cutting-edge AI, which Buffett views with genuine fear due to its potential for systemic harm.
This leaves us with a truly provocative thought for you to consider as you reflect on this deep dive. We see that Berkshire remains firmly committed to the American miracle in domestic stocks, viewing fixed income bonds as unable to resist uncontrolled currency devaluation due to unsustainable fiscal deficits in the U.S. This conservative outlook is embedded in the culture.
But here is the challenge. In a world where Buffett fears the enormous potential for harm from AI and sees unsustainable fiscal deficits in the U.S., can the future leadership replicate the success of the last 60 years simply by maintaining the core culture and sticking to low-tech industries?
Or will the sheer overwhelming size of their cash hoard, that $388 billion, finally compel Abel to break the mold and hunt for a high-tech, fat pitch that fundamentally expands the company's circle of competence and defines the next chapter of Berkshire Hathaway. That decision will be the first true test of the post-Buffett era.